Today, we are doing an honest, updated, and data-driven review of MP2 for 2026. If you are planning to invest next year, or you are wondering if MP2 is still worth it despite everything happening in the Philippines, stay with me until the end of this video because I will reveal the single most important factor that will determine whether MP2 will continue giving high returns in the future. Most people never talk about it, but it matters more than any past performance. Are you ready? Let's begin. MP2 is one of the most popular savings programs in the Philippines because of one simple reason. People want a place where their money can grow without too much risk. The last few years have been full of economic challenges. Inflation continues to bite, the peso has been weak, and many investments have been volatile. So Filipinos naturally want stability, predictability, and safety. This is where MP2 usually stands out, especially for long-term goals. The first thing to remember is this. MP2 is not a stock. It is not a REIT. It is not directly affected by the daily ups and downs of the market. MP2 earnings come from the Pag IBIG Fund's vast portfolio of housing loans, its regular programs, and its other investments. That is why the returns have been relatively consistent even when the stock market was flat or falling. This structure is what provides its signature stability. For context, here are the previous MP2 dividend rates. It gave 7.03% in 2021, 6.12% in 2022, and 7.05% in 2023. Historically, MP2 tends to move in the 6 to 7% range. Even during years when the Philippine economy had significant issues, MP2 still delivered solid returns. It's a powerful tool, but remember to align it with your personal risk tolerance and always maintain a separate emergency fund. So the big question is this: will MP2 continue to be a good investment in 2026? Let's break it down. The first factor is interest rates. When interest rates are high, Pag IBIG earns more from the housing loans it releases, which directly boosts its profitability. This, in turn, increases the fund's ability to pay higher dividends to its members. In 2024 and 2025, we saw higher interest rates globally. If rates remain elevated or only slowly go down in 2026, MP2 will still have strong support behind it, making it an attractive option for steady returns. The second factor is the consistent demand for housing loans. Pag IBIG is one of the biggest housing lenders in the entire Philippines. Even in a weak economy, Filipinos continue to take housing loans because owning a house is a fundamental long-term goal for many families. As long as there is this continuous, robust demand for home financing, the MP2 program remains well-supported and financially sound. The third factor is fund safety and institutional stability. MP2 is backed by the full faith and credit of the Philippine government, and Pag IBIG is one of the most profitable government-run financial institutions. It consistently reports billions of pesos in net income each year. This is critically important because when the institution itself is stable and profitable, the funds allocated for dividends are stable too, ensuring reliability for investors. Now, with these factors in mind, let's compare MP2 to other investment options available to you today. Let's start with time deposits. If you compare MP2 to them, MP2's dividend rates are consistently higher. Most bank time deposits offer around 3 to 4%, with some promotional rates occasionally hitting 5%. MP2 is almost always higher than that, and the advantage becomes even more significant when banks inevitably lower their promotional rates. Now, what about real estate investment trusts, or REITs? REITs can certainly give higher dividends, often in the 6 to 8% range, depending on market conditions and property performance. But here's the trade-off. REITs have price volatility. The market value of your shares can go up or down daily. MP2 has zero price volatility. Your capital is preserved. There is no daily market movement to worry about. So it really depends on your risk appetite. Do you want higher potential returns with some volatility, or do you prefer consistent, predictable returns with capital preservation? Finally, If you compare MP2 to the broader stock market, the difference in risk is even bigger. The Philippine stock market has struggled for more than a decade. The main index has gone nowhere, and many great companies have been affected by the sluggish overall economy. In a weak or sideways market, a simple, stable product like MP2 becomes incredibly attractive because you do not need to worry about price fluctuations or timing the market. Of course, MP2 will never beat a strong bull market, but right now, the local stock market is simply not in that environment. So is MP2 safe for 2026? As of today, the data says yes. The fund remains profitable, the housing demand is stable, the institution is strong, and the historical performance shows consistency. If your goal is capital preservation with decent growth, MP2 can still be part of your plan. But here is another question. Should MP2 be your only investment? The honest answer is no. Even though MP2 is good, you should still diversify. Relying on only one source of returns is not ideal, especially when the economy is uncertain. Your portfolio should include a mix of stable products like MP2 and growth-oriented investments like REITs or international stocks. This is how you protect yourself while still giving your money a chance to grow. Now let's talk about the most important part. The one thing people overlook. The one factor I promised at the beginning of this video. Here it is. MP2 will only remain strong if the Philippine housing loan repayment rate stays high. Most Filipinos do not realize this. Pag IBIG earns from people paying their loans on time. If the economy becomes weaker, if unemployment rises, or if loan defaults increase, then MP2 dividends can be affected. This is the real backbone of the returns. It is not the stock market, not interest rates, not promotions, but the ability of borrowers to pay their loans consistently. So what does this mean for you? It means MP2 is still good for 2026. It means MP2 is still stable, but it also means you should not put all your money in MP2. You should diversify, and you should also invest in assets outside the Philippines so you are not completely dependent on the local economy. As long as you understand what MP2 is and what it is not, you can make smarter financial decisions. The goal is not just to earn. The goal is to build a financial plan that protects you in the long term, supports your goals, and gives you peace of mind no matter what happens in the country or the global economy. If you want long-term stability, MP2 can still be part of your strategy for 2026. But if you want growth, you need to complement it with other investments. That is how smart investors build wealth over time.